And I know one of the dangers that a lot of people get lost in is trying to make an exact formula. That's old trader mentality. The more criterias, the more indicators, the more stuff that you add to your screen and to your process is just another decision point you have to consider. There's no lagging indicator out there that's going to get you to pick up on the truth of the cycle. Because one of the biggest questions that people ask when they email support or just in general is like, how do I only trade the trend phase? How do I just make sure that I just get in when it's going distance? The moment you put that on your screen, now you've given yourself something to toy with for who knows how long, that's ultimately not going to give you really any edge to adapt to the cycle quicker. So if the market is going to go down, if it's going to trend down based on ATS trend, every single box, this one, even these minor frameworks, but we really want to look at the major frameworks. The trend phase, we'll take into consideration this one and this one, because these are major framework. The trend phase on these will be to the downside, meaning that we will go through expansion and the market will trend down and form boxes of some type at lower prices. It will happen. So that being said, when you get a box, we already have a predetermined expectation that the outcome, the third market phase, will be to the downside. We have a predetermined expectation that this will expand, do whatever it does. And that's the moment this box appears, especially after it confirms that it's a major cycle, which happened right here. Predetermined expectation that however many expansion legs, how big they are, how long they take, essentially this right there, that activity, however long it takes, whatever it does, it will ultimately trend to the downside. And so that's what the directional bias gives us. It gives us a way to play our hand during this expansion cycle. So if we have a predetermined expectation that what is happening right now would happen the moment this box was formed and confirmed, then we'd be looking at value established by that box. And then the moment we became above value, and I have the expansion lines turned off right now, but we could still just go off the center of the box because that's based on the price. This zone right there is your entry zone. So you could see that this is basically narrowing it down to the price action. It's pretty much right there. That was it. And your initial profit target on something like this would be the swing low point of the cycle because we're expecting it to work down. So we'd be aiming for liquidity below these lows right here, which we came and traded below. And you could see that when we came through these wicks right here, it traded back up to those wicks. Now it's still working its way down. Now we're at the bottom of these cycle lows down here. So we'll see if we get through there. If we get through these levels, we'll probably see a decent move to the downside. But we may not be done with expansion here. We'll have to see. It may trade all the way back up to this high right here. But what we're trying to do, I can't control how many expansion legs happen through here. Again, this could come up and run the highs over here. Let me get rid of this box. I can't control that. I don't know when it's going to trend. I don't know how far it's going to go. I don't know a lot of things about how this is going to play out. What I do know is that we are in a down market confirmed by the inefficiencies the banks has shown based off of their footprint. That's what I know. So overall probabilities should be to the downside, especially because it's in alignment with the higher time frame holders on the 4-hour. They are going to hold. They're not going to make any decisions based off of looking at only a 4-hour time frame based on if they think they're going to be in the money in 4 to 8 to 12 hours, 16 hours, multiple candles. You think if you're looking at a breakout or whatever it is on a 4-hour, a bounce off support and resistance in general, if you only have a 4-hour chart up, it's going to take 4 hours just to see if you were slightly maybe right. And that's if it bounces on the current or the next candle. It's going to take a minimum of 4 hours. It's probably going to take 8 hours or 12 hours if there's multiple candles at the turn. But just think, for them to really get discouraged about their position, time is going to have to pass. So based off of The 4-hour alignment based off of the ATS trend showing us the direction based off of the inefficiencies, everything is still trending to the downside. So based off of all that, what I'm trying to say is that we have a preconceived outcome of each one of these cycles to the downside. And the best that we can do, because one of the biggest questions that people ask when they email support or just in general is like, how do I only trade the trend phase? How do I just make sure that I just get in when it's going distance? I wish I knew that. I wish I knew that. I don't. All I've ever been able to do, or the best I've ever been able to show, teach anyone, is based off of preparing, coming up with a directional bias, coming up with a preconceived outcome, and then trading in preparation for that outcome in a safe way. So how do we do that? We look at fair market value. We look at center of these boxes, and you guys would have an expansion line here, and we trade short above that fair market value in expectation that one of two things is going to happen. One of three things, actually. Thing number one, we're going to trade above value and we're going to deviate back to value. So if you got in here, value was basically 4 pips away. So even if it's a reversal, we're hoping that it'll put us in the money at least to the center point of the cycle so that we can at least get in the money and get out of the pain zone. Remember, ultimately, it doesn't matter what the charts are saying. You guys are subject to your pain and pleasure threshold. Everybody is. There's no way around it. The more money you trade, the tighter your pain allowance. So by trading above value after we've done this analysis, we have the highest likelihood of getting distance between our entry and our pain threshold and getting in the money. Because when you're in the money, it eases up and you can then start paying attention to the actual what's going on rather than looking at how much am I potentially going to lose. You want to get into that creative flow, but we got to get out of the danger zone first. So we're expecting to try to get from up in here just back to here. That would put you 4 pips in the money. If this was a 30-minute chart, that would probably be 20 or 30 pips. So it's all the same across time frames. Thing number two we would be looking for would be to get through fair market value as we did right here. We gap down through it and then go to the swing low on the cycle. This is just classic counting expansion legs. We have 1, 2, 3. This would be our 4th expansion leg that we're in right now, or it could be the trend phase as well. We don't know. So that's thing number 2 you'd be looking for. So thing number 1, entry to value. Get safe. Thing number 2, go down to the swing low point. Thing number 3, get through the swing low point and hang on as long as you can to see if it's the trend phase. Find some profit targets potentially down here. Use order block projections, liquidity lines, previous framework on the higher time frame, you name it. Which one do you use? Which one would you use in this situation? Use whichever one is the most relevant at the moment. So as of right now, I know I don't have order block projections on, but let me turn them on. I haven't actually tested them since this new update, but let's check it out. Let's see if we got anything. All right, beautiful. So that's pretty relevant for a conservative profit target right there. It's 14 pips away to that order block projection. Based off of the entry zone, that'd be a 34 pip trade on a 1-minute chart, which is not bad. So that's pretty relevant. I think that that's a safe one. I'm not going to turn on liquidity lines just because we got other stuff going on here with the institutional levels from the 30-minute. So I don't want to get it too clouded. But this is a good relevant thing to focus in on. Also, if you look at the 30-minute, based off of what the lines that we're looking at here, I would be looking at this level right here. Why would I look at that level? So I would look at this level because I can clearly see the market crept up to it and then boom, just blew through that. I know that there is a lot of stop losses starting from basically here down to these points down here. And I know that if we get down through this level again, these stop losses are really going to cause the market price to collapse likely. So that is a based off the higher time frame framework, I'll be looking at that as well. So this is about 12 pips away from where we are right now. and the order block projection is about 12 pips. You notice that there's a correlation. If I pull up this, see that the order block projection is literally the identical level of that institutional level on the 30-minute. So there's correlation there. So now I have even more of a reason to target that order block projection. So I'm not overthinking this and trying to make a specific formula. I'm looking at what are reasonable levels of framework that price can reach for in the next hour. That's it. And I know one of the dangers that a lot of people get lost in is trying to make an exact formula. That's old trader mentality. And it's not what we're trying to do here. CS is about reading the book page by page. And we're doing that within a set of best practices. The best practices are understanding the higher time frame cycle and direction, because we want to know how long those holders are going to hold their money. We're very interested in that. Other than that, we're trading the cycle and we're positioning ourselves in a range, not an exact candle. There's no little bell that can go off here. I know people like they try to time this with a MACD crossover. They try to do that. Do not add those things. It's just going to add more criteria and more confusing things for you to take into consideration. We're trying to find the best entry in a range up here above value in expectation that the trend phase will be to the downside the moment this box was established. So best we could do is position ourselves in a strong way that will help us hopefully not experience too much pain with the negative movement against our position, but put probabilities in our favor that we're at least going to come back to center of gravity at value, get down through, go to the swing low point, and potentially hit the trend phase like we are right now. Now, second thing is people ask, well, do I wait for it to trend all the way down and then I don't get out until I see a new box? That is up for debate. Sometimes you'll wish that you waited till you got into a box. Sometimes you'll wish you just traded to a target, because we still can hit this down here and have a massive reversal coming back up to here. All that ATS can do for you at the end of the day with reasonable certainty is get you back to value from here to here. Once you get to here, you're trying your best based on experience, based on your feel of the market. You're trying your best to see if you could hang on through value, down through the swing low point, and then into the trend phase. Your ability to do that's going to be based off of your experience watching candles and price action. It's going to be based off of where you're at for the day. If you've already taken 2 or 3 losses and you're down at the swing low point, you might be just happy to make back the day. These are all things that take into consideration how long you could hang in there. Now, if you're already, or whatever's happened in the day, you're already up a little bit, and now you find yourself in another profitable trade, you have now earned the right to hang in there a little bit longer, which you very well can do. So these are the questions you have to ask yourself. There's no specific formula. All there is best practices that keep probabilities in your favor, and then your experience as you go. The more criterias, the more indicators, the more stuff that you add to your screen and to your process is just another decision point you have to consider. And I know a lot of people think the more criteria is the more I add to this, the more indicators, the better it's going to be. And it's not. If that were the case, then robots, there would be a bunch of different trading robots out there that would work great. And everybody would be rich without doing anything. The reason why robots don't work is because they don't adapt quick enough. Our system of looking at the market is the quickest way to adapt to the weather. We know the first drop of rain, figuratively speaking, we can pick up on because we can tell when the cycle is changing before anybody else. There's no lagging indicator out there that's going to get you to pick up on the truth of the cycle as fast as just watching it play out. So that's what we're trying to do, is we're trying to adopt quickly and then trade in line with that new reality. And so more indicators, especially settings-based lagging indicators like a moving average, the moment you put that on your screen, you have to consider what it's telling you. If you're not going to consider what it's telling you, why have it? So you've added another decision point. And you've also added other sub decision points with that. What setting do you use on the moving average? What number? What period? Right? Now you've given yourself something to toy with for who knows how long, that's ultimately not going to give you really any edge to adapt to the cycle quicker. So things like that is where people really get lost in. We'll get screenshots and I'll see people, they have 12 other indicators besides ATS on their screen. And they wonder why I'm not really getting this. Well, you've added several other decision points at minimum to your process. The process that I just went through right now, higher time frame direction, which way is it going? Why do we care? It's grounded in logic. The higher time frame holders don't change their mind, and unless they change their mind, then it's going to stabilize price. It's going to go back in that direction. Very simple. Lower time frames, entry and exit, values established, position above or below value based off the higher time frame flow of money. Step 3, what are the benchmark prices that are reasonable to reach? Pick a couple that are relevant to the current situation. We had order block projection. We have this line right here, which we basically just traded to exactly right there. Also our order block projection to the wick. We just hit it. That's it. That's a trading idea. You go from here to here, try your best to hang through here, which wasn't too difficult. Came up, held that as a support level, traded right down the order block projection. It doesn't really get much easier than what just happened right there. And that's really it. That's the process. Now you get out if you want to. It may go further than the order block projection, but I'd say that's a pretty good move. This on a 30-minute chart, 100 pip move. On a 1-minute chart, it's actually even pretty good. It's 34 pips, roughly. So, but that's it. You're done. Now what do? Wait for another box, wait for it to confirm as a major framework, ideally, and do it again. Same thing. If the trend is still short, trade over value, short the market over value. Establish your benchmark prices, starting at value, then swing low point of the current cycle, and then look if there is any recent relevant framework that is reasonable to hit in your time frame. If you're a day trader, don't shoot for a 100 pip move away based off framework. It's not reasonable. You should be, if you're a day trader, you're shooting for like 10 to 20 pips, ideally. That's it. Find framework that from your entry, your overvalued or undervalued entry based on the trend, that's 10 to 20 pips away. That's reasonable that you will hit that. And rinse and repeat over and over and over again. So that's pretty much it. It doesn't need to be any more complicated than that.